Hello everybody. I'm going to talk to you about cost volume profit analysis. But before I go into cost volume profit analysis, I want to remind you of what we talked about in Chapter 2. Because I think Chapter 2 is truly a springboard to what you're going to see in this chapter. And it's really important that you understand the nature of costs, not only the variable costs and the fixed costs, but also the mixed costs and how to determine how to break those out and how to evaluate how to behave, how costs behave. Because profit analysis really does hinge on your understanding of how costs behave. So if you need to, by all means, review Chapter 2 again, just to make certain that you fully understand the nature of costs, how they move, why they move, and how to interpret information based on that movement prior to stepping into cost volume analysis. Now remember, we're internal accountants. For the sake of this course, we're internal accountants. And we need to know how to calculate a contribution margin by unit. We need to know what the ratio is. And the question then you ask yourself is, why do I care? It's very important you do care. Because if you're operating an organization and you're selling a product, it's very important how much money you need to earn in order to gain a profit. What is your break-even point? At what point will you start to lose money? In terms of units as well as in terms of dollars. It becomes quite important if you're making a decision on whether or not to expand a product line and you do some analysis based on previous or similar products. It becomes important to use cost volume analysis to help you make some really sound business decisions and if at all possible, not lose money. So we're going to also talk about how to use the break even and how to determine your target profit margin, both in terms of units and also in terms of dollars. And your margin of safety, what is that level of profit just above your break even do you want to achieve? This allows you to evaluate your organization, evaluate your managers or leaders or department heads or operations directors, evaluate their performance. How well are they making these cost decisions? And your job also is to make sure that they're informed. They can use good information, not complicated information, practical everyday information relevant to what they need to do. So, what is a contribution margin? Well, we talked about that in Chapter 2. Contribution margin is going to be your sales minus your variable costs. Remember, sales minus variable costs is your contribution margin, which is very different from financial accounting. I want to make sure I make that very clear. This is not like financial accounting. But it's important for you to see that the contribution margin is really going to be where you start on a lot of different things. And you're going to start using that information. So know what it is, know it right off the bat. It's going to be your sales minus your variable costs. That's going to be equivalent to your contribution margin. So, cost volume profit analysis. Remember, we talked about how costs behave. Variable costs behave in proportion to the volume of activity. So when your costs go up, it's because your activity is going up in direct proportion. And we also talked about changes in costs be not so much a direct proportion. Some of it we have our fixed costs, and they are in step. As volume changes, our fixed costs change, and then changes again based on changes in volume. So our step approach. We talked about also using cost volume analysis to determine what is our variable cost per unit. How do we determine that ratio? We were using our high-low method. We were using regression just to help us understand the movement of costs and how to analyze the cost. And also, we wanted to see the relationship among costs and its variables. So it's important we can see a relationship. If we can see that these two variables are related to one another and there's strong relationship, if we move one, we know the other one is going to move. And it helps us predict, it helps us project, and it helps us understand the nature of what our numbers are telling us. So, variable costs. The components of the cost volume analysis are obviously going to be your sales price. It's going to be your volume. It's going to be your VC. It's going to be your FC. FC is going to be your fixed cost. It's going to be your variable cost. So all of these variables are very important. And you've talked about them. We talked about them in a couple chapters previous to this. So these are not new terms. Now we're going to put them in a context of cost volume profit analysis. So we want to assume a few things. It's very important to make certain that we got some assumptions. And one of the assumptions is the sales price. We want to make certain within a certain level of volume, our sales price is not going to change. And I know this is not in reality, but for sake of our example and for sake of the chapter, let's assume that We also want to assume that our managers are able to classify costs as variable or fixed. And we want to also assume inventory levels, a stable level of inventory. Okay, again, real life, these numbers are going to change quite a bit and they're going to vary. But for us in understanding how cost, volume, profit analysis work, we want to have some stability and a little bit of a constant to make it so that we can understand it a little bit better. But again, this is far more simplistic in the real world. Things are not always constant when it comes to our inventory levels. The sales price, it does not stay constant. In reality, we have sales prices, we have discounted prices, we have discounts to our customers, and so we got a lot of different moving parts in the real world. But let's just make it simple so that you can understand the concept. So, as we know, contribution margin is going to be the sales minus the variable cost, and that's going to be that difference. It's similar in many ways to financial accounting, where you say your gross sales minus your cost of goods sold gives you your gross profit. It's a similar like that, but again, we're on the managerial side, so we don't necessarily need to know cost of goods sold. In this case, we care more about our variable costs. And again, we will talk about cost of goods sold, cost of goods manufactured later on, but for right now, consider our contribution margin is going to be the difference between our sales revenue at the gross level and our variable costs. And then so our unit is just, again, dividing the two numbers together, getting your contribution margin per unit. The main point here is, what is your contribution margin? Because you're going to need that both in dollars and in units when you're trying to calculate your break even. So that's very, very important. I think this chapter has a lot of examples, which I don't know if it's effective in this kind of forum to go over. But I will say to you, the first thing when you're working through this chapter, I think you need to practice on how to calculate your contribution margin. And I know that's a simple calculation, but it becomes important because it is going to be the basis upon which a lot of the calculations that we're going to be doing going forward. How are we going to calculate our break even? How are we going to calculate our break even in dollars versus in units? How are we going to calculate? So it's a lot of calculations that's really going to hinge on that. So that's critical. Learn how to calculate your contribution margin in dollars and by units. So with that example, if we want to make certain that we have a contribution margin, we assume that Kay has some online business. She sells her posters for $35. Each poster has a variable cost of $21. So it's a variable cost of $21 per unit. Her fixed cost is $7,000, and this is overall. Her relevant range is 0 to 2,000, and she's currently selling 500 posters. Now, we got a lot of information here. And what we're doing with this information really is just giving you a very, very small contribution margin. So if we want to calculate what her gross sales are, all we need to do is just take the cost, the sales price, $35, multiply that times 550. So that's the first thing we're going to do. All right, so I'm going to do it here on my calculator, but you do it yourself. I want you to go follow through and do these on your own because I think it really does help you understand. So if they sell 500 units and they are going to sell them for $35 each, we can assume already what the sales revenue is. Now that we got our sales revenue, and I'm not going to tell you what it is because I want you to tell me as you're going through this video. If we say it costs us a variable cost of $21 per unit, we're going to take the $21 and multiply by the number of units that they sold. And we get, again, another number. Again, so we got our sales price, we got our variable cost. Now we can take the difference between the two to come up to our contribution margin. So let's look at the next screen. See? And as we said, we have our $35 times 550 gives us $19,250. Our variable cost is going to be, again, the number of posters sold, which is 550 times our cost per poster, which is already given to us. We didn't have to calculate. That gives us $11,550. So the difference between our sales price and our variable cost is our contribution margin, which is $7,700. Now we can take what our fixed costs are, and that gives us $700 as the difference between our fixed cost and our contribution margin and our operating income. This basic example should be the first example that you hone, and I mean do example upon example of how to calculate the operating income for a managerial company. Sales revenue minus our variable cost gives us our contribution margin. We subtract from our contribution margin our fixed expenses, and we then get our operating income. Think about that. So now the next thing is, if we are going to think about our contribution margin, what is our contribution margin per unit? Well, that's not too easy, not too difficult. It's going to be our sales price per unit. And we were told that sales price is $35, and we're assuming our sales price is going to stay the same. That's what we're assuming here. So if we're assuming our sales price is going to stay the same, 35 minus our cost per unit, variable cost per unit, we get a $14 per unit contribution margin. So every single time she makes one sale, $14 is her operating profit or her gross profit, if you're thinking about it from a financial accounting perspective. But in this case, it's a contribution margin. So that means that that $14 has to be sufficient, right, if we're going to make money, to cover our fixed expenses, right, and thus earn a profit. Next, we're going to talk about contribution margin ratio. Ratio of contribution margin to sales revenue. So basically, we're taking the $14 and dividing it into the sales price, and that gives you the contribution margin. And again, that's 40%, or it'll give you basically a decimal, and your job is to convert it to a percent. So $14 divided by $35 gives us 0.4, which is 40%. Why am I concerned about these ratios? Why are they important? Because when you're thinking about your organization and they're trying to establish goals, profit goals, production goals, budgeting, etc., this bit of information becomes quite important because it gives relevance and accuracy and some credibility to the why you are doing it this way and what will be the output if you do it this way and you get the results. So you're making a decision about forecasting next year, and they ask you, they say, well, Deborah, what is our contribution margin ratio? Then they're going to expect you, or me in this case, to know how to calculate it and using real numbers, everyday numbers, numbers that are completely, absolutely fixed in place. We know exactly how much our variable cost is per unit. We know exactly how many sales we've had in the past 6 months. Using real information, we can tell them with accuracy, this is what your contribution margin is and what your ratio is. So that means if you want to earn a profit, you're going to be spending 60% of your cost is going to be covering your variable costs. As simple as that. It's going to be 60% of your costs. They're going to be covering 60% of your revenue. It's going to be covering, great. Going to be covering. So we've got great information. We have information that we can use. We have information that will allow us to take it a step further. The question is, what's our next step? Break even and target profit. Why do we care about that? We care because if we are going to survive as an organization, we better know before we lose money, where is that point where it will be, we're losing money. And to know how much, to know that is to know what your break even. What is break even to begin with? A break even is where you don't earn a profit and you don't incur a loss. It is when your cost is equal to your sales price. So, sales at a point where your operating income is zero. We want that. We want to be able to know that. How can we determine that? How do we know if it matters? It matters. And we want to talk about this quite a bit in other chapters, but let's just get started and talk about so if you are familiar with break even, you understand how important it is. This number tells me that my operating income is zero. I'm not losing money and I'm not gaining a profit. And nobody wants to stay in business breaking even, but I tell you this, that information is absolutely important. If I sell a certain amount of units, this is the number of units I need to sell in order to break even. That's a bit of information that I think every organization that sells products wants to know. They need to know. So I think it's important for you to understand how it works and how to calculate it. So let's go to the next step. Now, I see that these two different ways of doing it, but I have to tell you, It's got to be an easier way than looking at it like this. I tell you, it looks so scary. But don't worry. We want to find out break even. We want to know how many units that we need to sell in order to not earn a profit, but not lose money. Think about this think about this particular spread that you're looking at right now, and visualize in your own life, not necessarily in a business, in your own life. At what point do you want to make certain that you do not lose money? How do you go about making that determination? Do you use a statistical approach to doing it? Do you really analyze exactly at what point will I, based on my income and my expenses, both variable and fixed, how can I come up on top? How can I have a little bit extra? Or what happens when it all falls out and I'm down to a little bit less revenue and my expenses, pretty much my fixed expenses stay the same. My variable expenses have gone down, obviously, but I still don't want to lose money. I don't want to tap into my savings. How can I keep myself afloat and not have a profit? Okay, I can understand that, but how can I not lose money? And organizations think about that in the same way, and how can we, we want to obviously thrive, and we're doing everything we can to thrive, which is why we sell the product that we sell. But it becomes important, particularly as the environment becomes more competitive, where these types of questions and answers need to be asked. These questions need to be asked and answered by managers. They need to know, most oftenly, they need to know before they even launch a product full speed. If they are launching a new product and they want to have an idea of what point they need to say, that's it. We want to cut this off right here. This gives them that information. And again, as we're talking about all of this, it's all about practical everyday decisions that business managers make all the time. And your job is to understand why they make those decisions, or what impact would this knowledge have on a decision that they need to make. We really want to see managerial accounting to be more of a practical approach to understanding accounting and how important it is for organizations to use accounting in their operations. Okay, so take a look at this slide for a moment and think about the point of break even and the information it gives a user. Now, once you got to understand the logic behind this, let's deal with a formula that makes sense. Textbook may have many different ways to calculate break even. I think this is probably the easiest way, the absolute easiest way. We want to break even. So we want to take our fixed expenses plus our operating income and divide it by our contribution margin per unit. We know what our contribution margin per unit is. And that's the sales price per unit minus the variable cost by unit. That's basically what it is. So if we take our fixed cost, which is $7,000, plus zero, because remember, our operating income in a break-even situation is always zero. We know zero is you don't earn any profit, but you don't lose any money. So fixed expenses plus zero divided by our contribution margin per unit should give us the number of units that we need to sell, right, in order to break even. Now, if we want to know our sales in dollars, how many sales in dollars? So we know 500 units, but how many in dollars? So if we want to know our contribution, our break even in dollars, again, it's going to be fixed expense plus zero. Remember, zero is the key here because we don't want a profit, we don't want a loss. So 7,000 plus zero, or fixed expenses plus zero, divided by our contribution margin ratio. And remember, we've gone over how to calculate that contribution margin ratio. It's the relationship between the sales and the contribution margin in dollars. So we know that. So now we take 40% of this 17,000, basically 7,000 divided into 0.40, it gives us $17,500. If we sell $17,500 in units, we will essentially have a zero operating profit. Now, if you say, I want to be able to target the amount of profit, now we get to a little bit more analytical. Okay, what if we say, I want to have a profit of $5,000, or in this case, $4,900 in profit? That's what I'm targeting. So I say my fixed expenses, again, stay the same. Our contribution margin, again, stays the same. So all we need to do is plug in, instead of putting a zero there, we plug in at $4,900. So 7,000 plus 4,900 divided by $14 gives us 850 posters. Again, we will not only exceed our profit, but we will make an operating income of 4,900. This is a good tool for an organization to be able to target how much units they will have to sell in order to target the type of income or profit that they are looking for. Again, managers are being evaluated based on the decisions that they make, and this is a very big one. They're going to be evaluated based on if did you keep within your margin? How far off did you get to your margin? Did you go above your margin? Yes, we exceeded, because we internally, our unit just had a $4,900 profit mixed into what we were thinking. So instead of just saying I'm going to create 500 posters just to break even, I'm going to create 850 posters so that I can get a $4,900 profit. And we reached that. And again, that says a lot about managers and leaders of an organization, because guess what? They have to make certain that they are evaluated on the results of their operations. And these are key indicators of an organization's holding a manager responsible for the profit of that particular unit that they're selling, that particular department. So how much is sales revenue? So we're going from bottom to top. How much revenue do we have to generate in order to achieve that $4,900 in profit? And again, this is all about using the information in various ways to answer different types of questions. And as you go through this chapter, you'll see there's a lot of questions that you can ask to get an idea of where you're going and where you've been really. So determine your sales volume and use it as a point of reference. And obviously, we want to keep things fixed. Draw a line on your fixed expense line. Again, we want to see relationships, and I want to see this in a variable, in a graph. So I think explaining in a graph is a little bit better. As you can see here, it talks about 500 units as the break-even point and 17,500 as the revenue at the break-even point. I like this graph because you can see so much than using the words. We already know what our break-even point in dollars and in units. Now, we can see up above the break-even point, this is where we start earning money. This is where our income becomes, and our profit becomes very, very important here. And then we can see here, this is where we're losing money. 7,000 is our break-even point. Well, this is 7,000 is our fixed expenses. But you can see, as sales increase, so does the volume, and so does the profit. What I have to say about this graph is this. What you want to know is how many units I need to produce to break even. And you know how to calculate that. How many units do I have to produce in order to break even in dollars? How to calculate that as well. We want to know how many units we need to produce if we want to target a specific operating income. We want to know how to create or know the revenue amount. What is the revenue amount equivalent to our targeted operating income? We know how to calculate that. So in the end of all of this, you are able to answer some very important questions that every organization that sells a product will have asked or are constantly asking. Where do we stand with profitability? Are we meeting our goal? Our goal in this case is to have revenue, operating income of $4,900. How many units did we sell to achieve that? You can tell them. How many units we need in order to just break even on this unit line? You can tell them that. Again, this is all important, everyday information that you can even use in your private life. Determine how much money or income I need at the expenses I have, both variable and fixed, to be able to save X amount of money. I mean, if that's the way you can think about this in order for it to make more sense to you, I would use that analogy. How much money do I need to make? I mean, I already know what my variable expenses are, my utilities, etc. I know what my fixed costs are, my rent, etc., or my car note, etc. So how much do I need to make in order to make certain that I don't have a zero? That means I want to have a certain profit. I want to have a certain amount of money I can save. You get what I'm saying? So that's the kind of questions that you need to have answers to. Maybe you don't want to ask that question because it's hard and it's scary. But truth is, it empowers you to have that kind of knowledge about what break even looks like to me. So sensitivity analysis is at the what if. You and I, on a personal level, are scared of that what if analysis. Truly, we really are like, oh my God, what does that mean? But what if technique is a very important one because organizations have to ask the difficult questions. They have to go there. Competition is such that you can't be afraid. You have to go back and look right at the data and answer the questions. What if the sales price change? What happens in the market if the price that I'm selling for $35 actually the market dictates I'm only going to get $30? What's that difference? What's that $5 going to do to us? How's it going to affect our break even? I mean, these are questions, are really good questions. And if a company wants to stay in business, they're going to have to answer those questions and be prepared to do what's necessary to deal with the result of those answers. So think about that. Sales, price, and volume, break even, all of that is all about an organization making decisions on how to be more efficient use of their money and their resources to generate a profit that will allow that organization to be viable in the future. And your job as a management accountant is to provide them with the data, explain what it means, and help them make the right choice. So, again, understand the relationship between the break-even point and fixed costs, understanding the relationship between variable costs and variable costs and volume, or the volume of activity, knowing when you need to make a change in your target operating and what impact it will have on the number of units you need to produce. Again, if you want to increase your targeted income, you're going to have to increase the number of units that you have to produce, and sell. So it's all about those relationships and seeing how they all fit together and in total help you make decisions. So, again, we don't get too complicated here. We just want to make certain that if you're using different types of different lines of the organization, different products, you can do your break-even analysis on a specific product line or a specific department in that product line. Again, it's all about what information, how deeply you want to drill down and ask those really critical, important questions and make decisions based on that. Multi-products or individual products. Again, it's all about being able to ascertain the best process by which you can determine the break-even and using that information for decision making, for goals, for budgeting, capital budgeting, cash flow budgeting, etc. Now, again, we're not talking about budgeting in this context, but break-even actually has a role in this. So it is important these fundamental chapters 1 through 4 that you really get the concept, because in chapters 5 and 6 we're going to talk about budgets and how important they are and how all this information that we're talking about today actually fits in and actually helps you. Margin of safety. Again, we talked about having a product that we want to sell and we want to know if it's going to produce money, what's the break even in dollars and units, and what's our targeted operating profit or operating income, etc. We talked about all of that. But what we didn't talk about is the margin of safety and what does that have to do with what we've learned so far. Margin of safety is excess of actual or expected sales over the break even. So if my break even in my example is 500 units, my margin of safety is going to be a level over that. It's going to be the excess over my break even point. So my margin of safety is the difference between that. So if I produce 600 units and my break even is 550 units, my margin of safety is 50 units. It's the difference between the two. So again, it's all about if something happens in our sales, do we have enough margin of safety to cover it without incurring a loss? That's our margin of safety. That's our little catch to make certain that we do not make sure that we don't lose money. So if you have a product that's risky, you want to have a lower margin of safety. You really want to have a lower margin of safety just to be safe. But if you have a higher margin of safety, you're talking about a product that's pretty much mature and established within the environment, and you could probably have a little bit more of a cushion there or a little less of a cushion. That point I'm making is organizations use this all the time. Profit is something that is given. They work hard for it, and the competition in the real world is there. And so questions like this are not unusual, and they're absolutely vital to understand and know and change and modify as necessary. My goal here in this chapter is to let you know that margin of safety, break even, and all of that have real value in organizations today. And I am 100% certain that the Walmarts of the world, the Targets of the world, all of those organizations are very concerned about their margin of safety. They're very concerned about break even, and they consider that, I would say, on a monthly basis, and if not at all, on a quarterly basis, and make adjustments accordingly, which is why sometimes you see products come and go depending on the organization, because they cannot permit a loss in this particular product. And a decision was made based on the break-even analysis and all of that, that this product needs to be discontinued. And we're going to talk about discontinuing products in another video. So that being said, think about the risk, think about the industry, think about the volume of sales, think about all of that, your leverage. Your operating leverage is your mix of equity and debt in order to make certain your financial operations. You're appropriately leveraged because you have a combination of equity and debt to maintain your organization. So all of that is important. But in the end, you want to make certain that you are able to assure your managers that they can maintain a level of health within their particular department, because they have knowledge of what their break-even points are. They have knowledge of what their operating profit margin and their margin of safety amounts are, and they modify those numbers to ensure that their continuity of business and that they don't affect their profit margin. So that brings this chapter to an end, but I have to tell you, this is a very important chapter, and it does have relevance in the real world. My hope is that you can find ways within your organization that you may use this information, and hopefully it will be helpful to you. Thank you very much for your time.